What is up, traders? Hope everybody's doing well. Today's session is going to be about liquidity. This is a very important session. This is basically the whole premise of how we trade. So what is liquidity? So first of all, to start, why does the market move? When a candle moves up or down, when we have an uptrend or a downtrend, where is the market headed? It's one of three things. It's either headed to equilibrium of a previous move, right? So 50% of a previous move, so it's doing a retracement. Or the market is heading towards a fair value gap, as we discussed, a volume imbalance, liquidity void to fill those up. Or the market is headed to take out or sweep equal highs or lows, session highs or lows, daily, weekly highs and lows, all of that. That is liquidity. Okay, anywhere you have equal highs, something like this, I'm going to show you guys, where you have equal highs, you have liquidity resting above. Equal lows, you have liquidity resting above, and the market will seek that liquidity to take it out. Session highs, so London session highs or lows are the most important to us. London session. Daily highs and lows, weekly highs and lows, 4-hour highs and lows, 1-hour highs and lows. All of these are areas where liquidity rests, and we're going to go over them in this lecture for you guys to understand properly, right? So let's start. First of all, the first form to find liquidity is double tops, double bottoms, or equal tops, equal bottoms, even triple tops, triple bottoms, right? So in this image, in this region, we have multiple areas of double tops and double bottoms, or equal highs, equal lows, same thing. And basically what happens is, let's assume that we have a trader that took shorts from this region right here. Let's just take an assumption that we have a trader that took shorts right here, okay? Or let's assume it took shorts from here. Let's just assume that we have a trader that took shorts. He had his stop loss here. He dragged his take profit to, let's say he wanted to target, this trader wanted to target these lows over here. Let's just assume, okay? So what happens is, we all know that to manage our trade correctly, we must act correctly when we're in a trade. So when the market is moving in your direction, this is part of the risk management lecture that I'm going to give later on, but for now, when you're in a trade and the market is moving in your direction, your stop is never staying in the same place. You're always moving your stop to break even or to new structure, new highs, new lows, to mitigate losses if the market reverses on you. Like in this case, what happened, right? If a trader took short here, he was in profit for a while, and then the market eventually reversed on him, right? So what happens is, when the market goes in a trader's direction and it starts to create structure, the trader to mitigate to mitigate losses or to minimize losses, they drag the stop loss. So what happens is, they drag their stop loss above structure. So what happens is, with time, you have a liquidity buildup above certain levels and below certain levels, right? You have stop orders and buy orders filled, or they're all placed in similar areas. Let's assume we have like 1 million traders that entered short here. A big portion of them are going to put their stop loss here once market is right here, for example, right? They're going to mitigate stop. So there becomes a big pool of liquidity right here, where there's a lot of stop orders resting right there, that the market will eventually want to seek for it to, let's say, get a boost. Let's put it that way, right? The market wants energy. So these stop orders and buy orders that are resting on lows, the market seeks them for it to gain energy, to boost it to where it wants to go, okay? So what happens is this, our friend here, Jack, for example, he took a short, and at one point he moved his stop loss here. Now, for retail traders, obviously we're smart money. We know these traps, and for retail traders, what happens is when they move their stop loss, for example, to these regions, the reason they move them is retail concepts. For example, let's look at this region. They look at it as support and resistance. So they say this level is holding as support, so I'm gonna move my stop loss here. It's safe. For buyers, for example, they say these regions they're holding as support, so they move their stop loss there. It's like they view it as strong areas, support and resistance, which obviously for us smart money concept traders, this is in our eyes completely false, and this is traps. So what happens is this trader, when he's in shorts and in the market, let's say at one point he moved his stop loss here, and then let's say 200,000 traders, we said a million took shorts here, let's say 200,000 of them, when the market was here, they moved their stop loss to this region. The reason because is they saw it be almost tapped into multiple times and price rejecting off, so they assumed that this level is a strong level. So some left their stop orders there, some moved to this region, but the point is there's liquidity above this high because you have multiple equal highs, and then you have stops above this high because you have double highs. So this is seen by retail as a strong resistance. This is seen by retail as strong support, right? So the retail move their stops to these regions, or even they have their stop losses at these regions, right? So what happens is these places have a lot of liquidity that the market will want to seek, right? So what happens is when you have these equal highs, equal lows, is the market will seek later in the future. We can see here how price very beautifully a lot of the times delivers and sweeps these lows and highs and then continues in the direction it wants to go. So that's the first form of liquidity, is equal highs, equal lows. You have liquidity resting above and below these highs and lows, right? The second form, by the way, if you see this high, we said liquidity rests above highs and lows, like swing highs and lows. That is true. Like for example, this is a swing high. It was swept. This is a, let's see here. This is a swing low right here. It was swept. So even swing lows and swing highs, liquidity rests above and below them. So that's another thing. Like even this high right here, you guys are gonna say, okay, it wasn't swept. Well, I can guarantee you in the future it was swept. So if we take a line from here and then we drag it, I can almost guarantee you that, yep, right there. In the future, it was swept, right? So swing highs, swing lows, in turn, double highs and double lows. These are all areas where there is liquidity resting, and there's a lot of buy orders and sell orders resting above and below these places where the market is going to seek, and that is mainly where we target when we take our entries and trades, right? So again, you got equal highs, equal lows, so you got liquidity in general. The market wants to rebalance the fair value gap. So if we go back to this example right here, this is a fair value gap, by the way, right? This is the fair value gap. So the market rebalanced to it. If you go back to the fair value gap lesson, hopefully you guys didn't forget, but this is the fair value gap right here, and the market rebalanced to it. So fair value gaps, volume imbalances, liquidity voids, and then equilibrium, which is basically the midpoint of a price range. Price will want to rebalance. It's part of rebalancing. Price rebalances the movement. You won't see a market just move up like this and continue to move up. It will eventually come and fill all these inefficiencies, or at least to midpoint, right? The markets are efficient in their movement. So that's the first form. We got equal highs, equal lows, swing highs and swing lows for liquidity. Another one is session highs and lows. And for us, the main one that we're going to focus on is London. London session highs and lows. For us, that's their bread and butter. And when we're looking at London session highs and lows, we're not looking at all of London. We're looking at specifically from 2 a.m. New York time or Eastern time to 5 a.m. Right. So set your time zones to New York time. It is from 2 a.m. New York time to 5 a.m. New York time. At the beginning, you guys are gonna mark out like I have right here, but with 2 horizontal lines, like so, right, to make it easy. And in this region, you want to look for the highest high and the lowest low. So for here, for between 2 and 5, you're gonna look for the highest high and the lowest low and mark those out. This is London low. This is London session high. These are very nice draws on liquidity to target. When we enter positions, we can see here how price swept London low, and then within New York session, which New York session starts at 9:30 New York time. So between 9:30 and 5 is New York session. So session highs, specifically London highs and lows, are very important draws on liquidity. In the beginning, you guys can mark out, like put 2 horizontal lines between 2 a.m. to 5 a.m. to make it easier to identify the highs and lows. Mark those out, extend them to the chart. These are targets. If we have London session lows taken before our trading session, which is during New York, we can try to target London highs. That is a very nice draw on liquidity. If the London highs are taken first, we can try to target London lows. That's a very nice draw on liquidity. That's the second kind of form of liquidity that we've talking about. We've talked about equal highs and lows, daily highs and lows. So if you go on the daily chart, let's take off this like so. You can see equal highs, equal lows, daily highs, daily lows. They are all very, very important to look at. Very important. So this is a daily high. These are daily lows to mark out. All these every day high and low is a very, very important draw on liquidity. So the ones that you guys want to mark out for the recent days are the last 3 days, the highs and the lows of the last 3 days, right? So this is very important for the liquidity of the daily chart. You want to mark out the high and low of the previous 3 days on your chart. So let's say for me, the previous 3 days are January 31st, 30th, and 29th. I'll mark out the highs and the lows, the highs and the lows, the highs and the lows. These are very important zones of liquidity to target. So the previous 3 days, very, very important. Okay. So now we've talked about equal highs and lows, session highs and lows, London session highs and lows, daily and weekly, same on the weekly chart, highs and lows. These are very, very important draws on liquidity. Okay, so that's going to be basically it for the session. Again, to go over what I just said really quick. And by the way, you can go on any chart, 1 minute, 5 minute, 10 minute, 15 minute, whatever. The market is fractal in its movement, so liquidity rests above for example, this right here. This is a very nice zone for liquidity. You have all of this trend line liquidity right here, equal highs right here. This is a lot of liquidity generated. So if someone entered short from right here, for example, and the market moved in direct direction, dumb money or retail concepts, they're going to see this as a very nice support region. They're going to move their stop loss anywhere from here, anywhere around here, but the most is going to be at the highest point. So that's a very, very nice strong liquidity right there to take longs later when the rest of our signals do align. So like when the market opens, don't be surprised if the market does something like this and sweeps the highs, right? Because this is a very clean setup of buy side to sweep, right? So yeah, that is going to be basically it for this session. Go over it again if you need to. This session is just marking out or trying to identify where buy side and sell side mostly rests. above equal lows or triple lows, whatever, and highs, session highs and lows, especially London from 2 to 5 a.m., daily and weekly highs and lows. On your chart, you should always have marked out the previous 3-day high and low, right? So let's say, for example, today is Friday. You're going to mark out the previous 3 days. So Tuesday, Wednesday, and Thursday, you're going to mark out the high and the low of each of these days, right? Very important. These are very nice draws on liquidity to mark out. Those are basically that's, I believe, all for this session or this lecture. If I remember anything else, I'm going to put it or drop it. If you guys have any questions regarding, please shoot them. And until next time, stay safe, guys, and happy trading.